Welcome to the Riskwiser Zone, the podcast where we help you navigate the ever-changing landscape of stocks and finance. I'm your host, Louis, and I'm glad you're joining us today. As we begin this new episode, let's take a closer look at some of the latest developments that are making waves in the world of economics. First off, we have some concerning news from the world of GDP growth. According to experts, the U.S. economy likely grew at its weakest rate in nearly 3 years, with some estimates suggesting it may have even contracted during the first quarter of 2025. Now, before we sound the alarm bells, let's take a step back and examine the numbers more closely. The Bureau of Economic Analysis is set to release its estimate of first quarter GDP on Wednesday, and consensus forecasts are pegging growth at around 0.4%, a stark decrease from the prior period's 2.4% expansion. But some measures tracking U.S. economic activity suggest that the actual number could be even worse than that. The Atlanta Federal Reserve's GDP Now model is calling for a 0.4% GDP growth rate, while Goldman Sachs tracker indicates a 0.2% contraction. Now, I know what you're thinking. Is this the start of a recession? Well, let's not jump to conclusions just yet. A technical recession occurs when economic output contracts over consecutive quarters, so we'll need to wait and see what happens in the second quarter before we can make any definitive calls. But with some trusted observers like BlackRock CEO Larry Fink suggesting that the U.S. could already be on the cusp of a recession, it's clear that there are concerns about the direction of the economy. And speaking of concerns, let's talk about trade tensions and tariffs. The ongoing saga of Trump's trade policies has added a layer of uncertainty to the economic landscape, with many experts warning that tariffs function like a tax hike, tightening financial conditions and increasing uncertainty for businesses. As Goldman economists put it, tariffs weigh on GDP growth, and that's something we'll be keeping a close eye on in the coming months. Now, I want to emphasize that our goal here at the Riskwiser Zone is to provide you with balanced and unbiased analysis of the markets and economy. We're not here to predict doom and gloom or to sugarcoat the challenges ahead. Instead, we'll continue to bring you expert insights, in-depth analysis, and thoughtful discussion to help you make informed decisions about your investments and financial future. And that's all for now. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Stay tuned. Welcome back to the Riskwiser Zone. We're halfway through our show today, and we've got some exciting insights to share with you. Let's dive into the world of finance and explore what's been making headlines lately. We've seen a significant turnaround in the market recently, with many experts attributing it to the calm in global liquidity and India's relatively stable position amidst the trade war. But is this a permanent change or just a subtle shift? Sayan Mukherjee from Nomura shares his thoughts on this, highlighting that while things look positive for now, there are still headwinds to corporate earnings and risk premiums that need to be watched closely. Mukherjee also notes that the return of foreign institutional investors to the Indian market may be more tactical than structural, driven by the search for relatively safer havens amidst global uncertainties. This is an important point to consider, as it suggests that while the influx of foreign capital can provide a boost to the market, it's essential to keep a close eye on the underlying fundamentals. Meanwhile, Neeraj Dewan, a veteran investor, has been sharing his views on the current market setup, emphasizing the need for caution and selectivity. He advises investors to focus on quality stocks with strong growth potential, rather than getting caught up in the broader market momentum. It's also worth noting that not everyone is convinced about the sustainability of this rally. Some experts argue that valuations are still stretched, and the earnings growth may not be as robust as expected. This highlights the importance of maintaining a balanced perspective and being prepared for potential volatility. As we navigate these complex markets, it's crucial to stay informed and adapt to changing circumstances. At the Riskwiser Zone, we're committed to bringing you timely insights and expert analysis to help you make more informed decisions. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've had a fantastic show so far, discussing the latest developments in the world of finance and risk management. Now, let's dive into our closing segment, where we'll be analyzing a story that's been making waves in the automotive industry. As you may have heard, President Trump has announced plans to ease the impact of his tariffs on U.S. carmakers. The move is aimed at cushioning the blow of tariffs on foreign vehicle parts used in domestically manufactured cars. According to reports, car companies paying tariffs will not be charged other levies, such as those on steel and aluminum. This development comes as a welcome relief to the automotive industry, which has been facing significant uncertainty and turmoil due to the ongoing trade tension. Carmakers have been warning that the tariffs could lead to higher prices, reduced sales, and even job losses. The General Motors CEO Mary Barra and Ford's boss, Jim Farley, have both praised the planned changes, saying they will help level the playing field for U.S. carmakers. However, it's essential to note that this move is not a complete reversal of the tariffs. Cars made outside the U.S. will still be subject to Trump's tariffs, although they will be exempt from other levies. The plan is expected to provide some flexibility and relief to the industry, but it's unclear how effective it will be in mitigating the overall impact of the trade tension. As we analyze this story, it's crucial to consider the broader implications for the global economy. The ongoing trade war has created significant uncertainty and volatility in financial markets, and any developments that can help reduce tensions are likely to be welcomed by investors. In conclusion, the announcement by President Trump to ease the impact of his tariffs on U.S. carmakers is a significant development that could have far-reaching consequences for the automotive industry and the global economy. While it's essential to approach this news with caution, it's also important to recognize the potential benefits of reduced trade tensions and increased cooperation between nations. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.